This podcast is brought to you in association with BSE and its investor awareness initiatives. Investing holds different meanings for different people. For many, it's simply a process of making money. For some, it's a lot more philosophical. And then there are those who find a spiritual meaning in it. These days, we are hearing a lot about investing being an art. And then there is plenty of debate around that too. We are about to find that and a lot more from two accomplished practitioners in the field of investing. They need no detailed introduction to the investing community, having managed public money for decades. What these gentlemen buy and sell is watched closely in the market. Listen on because this promises to be a great conversation. I am Nishant Vasudevan, the markets editor of the Economic Times, and your host in this episode. First, I'm pleased to welcome Kenneth Andrade, founder and CIO of Old Bridge Capital Management. Welcome, Kenneth.
Hi, Nishan.
Now, to start with, for many people in the investment industry, the process of investing typically starts with numbers and ratios and spreadsheets and other things. For you as an investment practitioner, when does this science evolve to something like an art?
Well, it's a mathematical deduction at the end of the day, and you get better at it after you have been through years of experience with it, right? So, my investing journey started almost 30 years ago, and I've been through a couple of bear market cycles and a lot of bull market cycles. And I think experience has taught us everything. So, the numbers, ratios, deductions of how a company will grow, etc., would be completely meaningless if I haven't gone to see how all of these ratios did, all of these structures did in the past. So it's just an accumulation of experiences that you have that is what brought us to this stage. So yes, there's a science behind it and there's a math behind it. The art comes with experience.
Right, correct, perfect. As a fund manager, as an investor, was there a big turning point in your life that changed your approach towards investing? You know, that moment of epiphany, where you felt that, this is what, I shouldn't be doing, or this is what I should be doing.
So it was that effective journey in year 2000, all the way from 1997 to 2000, where nothing went wrong. And between 2000 to 2003, everything went wrong. It was that journey between buying value, okay, to believing that growth would to buying growth at any price or holding on to growth at any price, and the cycle that came after that, which was a mm, significantly large learning experience, and that's what's made me what I am today.
Right. Many people in the market will be familiar with your portfolio. They kind of might be knowing your stocks by heart, but very few might be knowing about your stock selection process. Basically, how do you identify a stock? When do you decide to buy it, and how much do you buy it? Now, it would be helpful for our listeners if you could elaborate with some kind of an example, something that you've done in the past. How you kind of how does the entire process work for you?
So fundamentally, we try to buy capital efficiency at a price, and that's where the art of investing actually comes in, right? Capital efficiency, everyone knows how a business is managed. Everyone can calculate the ROE and ROC of the business, right? But if the ROC and the ROE or capital efficiency is very high, in most contexts or in most environments, you end up paying a very large price for it. Okay. A great business is always available at a great price. So what we try to do is try and find a great business in an industry which is not doing very well. The company's profitability is also not great, but it is better than the rest. And that's where we like to step in. Simply as an investor, what I'd like to see in multiple markets is which company or which stock is hitting a 52-week low. That's my go-to place. Okay. So capital efficiency of one of the best businesses in a down cycle is a time where you get it at a reasonable price. That's a short and the long form of what the process is all about.
Could you elaborate that, for in terms of an example that something has worked well? for you in the past?
So let's put a case of something that we've done, and it's held us in relatively good stead since we started our journey, right? India's largest airline debuted at an X amount of market cap when the industry had 4 or 5 participants at that point in time, right? A very attractive business, a cost leader, profitable, generating cash flows in an industry which you would always find businesses struggle to generate cash flows, and then you hit a down cycle. This business on every single parameter, okay, traded at a valuation which is much lower than we've ever seen it before, okay, and continued its ability to be the cost leader. Today, that metrics is completely changed. So, aviation in India, or India's largest aviation company, is today the second largest in terms of market capitalization in the world. Okay, has got cash on its balance sheet. It's something that the world and something that this industry has never seen. Probably globally, you've probably seen it in 1 or 2 companies, but an Indian company having that. And one of the most important things is the marketplace is completely consolidated. So you got the price right when you got in, and it still holds itself in good stead in the entire competitive framework within its industry.
Right. So yeah, so everybody focuses on buying a stock, when to buy, when to, the timing of the purchase, the price of the purchase. But there is very little literature on selling part of it, which typically tends to be a lot more complicated. How do you think about this entire approach of selling?
Well, when an industry does well, the last common denominator in that industry, or the smallest company in that industry, starts doing extremely well. Now, think about it this way: when everyone in an industry makes money, you are heading towards hyper competitive competition, right? Because the largest company is investing and the smallest company is investing, which means more capacity is coming in. Quite contrary to what most investors would like to believe, that any industry where everyone makes money is a great place to be in. We hate being in a place where every single participant in an industry is profitable or is making money and reinvesting its money back into that industry. That's our sell side discipline, quantitatively putting it together.
In the recent past, have you come across any such setup in an industry which has kind of gone through this kind of a phase, and where you felt that there's going to be a fair bit of competition, and you think that it's a time to kind of move?
So let me give you a sense of what happened in 2006, 7, and 8, right? And you're seeing some similarities of that play out in today's environment. So what happened in 6, 7, and 8? We had this big boom in infrastructure, and every company that was out there was bidding for business. So the higher order book, higher market cap, more ability to raise money, higher ability to take more contracts. Okay. And that became the most inefficient part of the marketplace at that point in time. Capital is freely available. Companies want to build order book, because the minute you want to build order book, you're getting market cap. The minute you get market cap, you have to demonstrate your ability to get a higher order book, which is the first structure of deterioration of margins. When you have deterioration of margin, there's someone who's going to come and bid below your price. Something similar took place and within our portfolios at the asset management company. We basically built out a structure around pharmaceuticals which are outwardly facing. Okay. And the Indian manufacturers actually consolidated the global space in terms of generic manufacturing. Okay. That's the consolidation part. What you're seeing beginning is the fragmentation part in the infrastructure business. Now, timing this is completely different. Yeah, you'll have to work to see that you do not sell too early into a cycle like this.
Perfect. Kenneth, the other question that we have in mind is generally, you are a stock picker, and the biases normally tend to be the smaller caps. The general perception over there is that the corporate governance standards are not the best in this entire space. So, for you as a fund manager, what comes first? Is it the price or the corporate governance?
So again, Nishant, corporate governance can be quantified. Okay. Now let me put it this way: take a portfolio in our company and see if it's attracting the right talent. Okay. And it is getting incremental market share in its industry. Okay. If it's attracting the right talent and it's getting higher market share, now how can two of these things be wrong if it's got bad governance? So when I say you can quantify corporate governance, we can actually quantify corporate governance out here. Why am I talking about governance in a small cap business, right? So usually when you look at a business in a down cycle or in a down cycle and you try to capture a great business in a down cycle, mostly investors vacate that space because they want that industry to do well and the company to actually grow well. And when there is no ownership in that entire business because it's going through a rough patch, you usually get them at mid capish market caps, right? And I think that's a great entry point for all of us. So while our portfolio kind of represents small capish and mid capish bias, they're usually the largest companies in their categories. Just they represent their market capitalization because they're going through a weak cycle. Okay. So when we invest, we don't compromise on corporate governance. Okay. And we try to find mispricing, which you most often than not usually get it in this space or these kind of companies. And that's what we try to enable with the process.
Right. Yeah. So Kenneth, investing tends to be it's tricky. People kind of it is subjective. But according to you, in investing, what is the skill that is the most overrated, and what is the skill that is the most underrated?
Okay, the most underrated skill I would think is patience. Okay, nobody likes to wait on a stock. Nobody wants to buy it at its appropriate time. Okay, and that's what I think most investors almost always forget. Okay, and it's happened with me as a beginner investor. I just didn't have the patience to wait on a stock or to find it a little cheaper and to understand what makes a good business. Okay, and I think the most overrated part of investing is gut feel. Okay, or intuition. Because what drives intuition and what drives gut feel has to be quantitative at the back end. Okay, you can't wake up one day and say that intuitively I think this company will do well because this is the limited amount of data that I have. So you have to watch a business for an extremely long period of time. Okay, and that will drive intuition.
Right. Kenneth, before we wind up this discussion, our listeners would want to get some wisdom from you, on some kind of advice from you on investing. If you were to give them one good advice, one solid advice, what would that be?
I think everyone's in the process of finding the next big winner in a market cycle like this, right? So if you're trying to find a value where there exists none, okay, don't go searching for it. And I think this is very contextual, and I learned it in 2017-18. Despite all the years of investing into 2017 and 18, we went into a market cycle where I went looking for value where there exists none, right? So you got to tread a little carefully, have that patience and the discipline to stay away from things you don't know. Okay, and in a market environment like this, I don't think there's any value really to search out. Yes, there are businesses that will grow, there are businesses that will keep you safe, and there are businesses that will compound capital. They are all out there. You just have the discipline to wait till it comes to your price.
Thank you, Kenneth. Thank you for talking to us. Thank you for this great discussion. It was nice having you. And I'm sure our listeners have benefited a lot from this conversation.
Super. Thanks, Nishant. Thanks for having me on the show.
Now, I would like to welcome Sunil Singhania, founder of Abacus Asset Management. Welcome, Sunil.
So thank you for having me, Nishan.
So basically, people know about Sunil Singhania's portfolios, about the stocks you own, etc. But they don't know much about your stock selection process. Basically, how do you identify a stock? How do you buy a stock? How much do you buy? I mean, if it would be nice if you could tell our listeners about this entire process, probably through an example or something. How a past some kind of a pick.
So Nishant, when we set up Abacus, we had a very, very clear investment philosophy. Very quickly, I can run you through the investment philosophy. So first is we don't allocate, we invest. We are not going to invest in a company just because you want to have an exposure to the particular sector or something. We would like to individually on merit look at each company. Second is, at least from our perspective, we are very, very balance sheet focused. So we don't look at loss making companies. So for us, the return on capital employed is sacrosanct. And therefore, typically we invest only in companies where the ROCE or ROE is at least 14-15%. The second important criteria for us is the profit growth. And therefore, typically we look at companies which can double profit ideally in 4 years a maximum of 5 years, which is a 14 to 18% CAGR growth. Because if the profits double, the value of the business will automatically double. The third thing we look at, which is in the current kind of an environment, which is disruptions. Then the other thing is the valuation. Our view is that the best company is not necessarily the best stock. So if you remember 4 5 years back, we had come out with a note called bubble in quality. And our view was that yes, quality is good, but at what price? So if a company is trading at 70 80 P multiple, growing at 10%, I don't think an investor is going to make returns out of it. So we are very conscious about the valuations. So I think all said and done, these are the key criteria which we look at. Recently, we bought an auto ancillary company called Shriram Pistons. It was ignored, but it clicked all the boxes, And I think so far, Touchwood, it's been doing very well. Very, valuation focused investment, ROC, ROE of 24 25%, and growing also decently. This is just an example, but I'm just giving you a broad perspective of how we look at things.
Right. Sunil, as an investor, as a fund manager, what has been the biggest turning point in your life, that has kind of changed your approach towards investing?
No, I think 2 3 things. One is obviously joining a mutual fund and basically, getting into the groove as far as long-term investing is concerned. Second, as I said, we all learn from our mistakes. So many times you end up selling early. And those were huge lessons, I think in the case of Bajaj Finance, we were large investors when I was in Reliance Mutual Fund. We made good money, but we sold early. And from there on, the stock has multiplied 50 times. And I think from a turning point perspective, I think the biggest, I would say, learning is that if you are investing in equity, you have to be positive on the economy or vice versa. If you're positive on the economy, then only you should be investing in equities. And I think that is what we have basically tried to do.
So beyond ratios and the balance sheets and the industry prospects, do you also look at the softer aspects in your investment checklist?
So Nishant, in a mid-size or smaller company, obviously meeting the company makes a big difference. In a mid to small size company, the management becomes very important because the second layer and the third layer might not be as strong as the top layer. And therefore, meeting companies become very, very important. Hygiene factors, we do company visits. When we do company visits, we come to know, how they're treating people, what is the cleanliness, what is the, the whole quality aspect. That becomes very important. Obviously, when we go through multiple year balance sheets, their compliance in terms of taxation, are there any red flags by the auditors? I think those are again things which we have to basically look at. And more importantly, if you have a history of the company over the last 10, 15, 20 years, then you know how the company has behaved in different cycles. I think that also helps.
Now, Sunil, most investors, at least the people who kind of, who have started off, the entire focus is on buying, the timing of the purchase, the price of the purchase. But there is very little discussion on when to sell. What is your philosophy in this?
No, I completely agree with you. I think when to sell, how much to sell, whether to sell full, whether to sell partial is always a concern or a question or I would say an uncertain kind of a decision. From our perspective, there are 3 reasons why we would sell a stock. First is if we go wrong in a hypothesis, so we invested in a company based on particular assumptions or hypothesis, and that is not turning out well. Maybe the sector has gone, worse than what we expected. The company is not performing the way we expected. So I think the earlier you realize and the earlier you sell off, the better. Then you should not look at whether you would want to wait for a pop-up or not. I think you have to sell. Second is a lot of times, you go right and the stock moves much beyond what you would expect is to be the fair value. See, ultimately we are investors. We are investing from a 3, 4, 5 years perspective. But if you feel that, in the next 2 years, the stock has discounted what you thought was possible in 4 to 5 years without any significant improvement in fundamentals, you would want to book profits. And the third important decision is, capital is limited. So if you have something in the portfolio and you come across something else, which is looking much better than what you already have in the portfolio, obviously you would like to switch. So these are the 3 main reasons why we would sell a stock.
And what, according to you, is the most overrated part of investing as a profession, and what is the most underrated skill required? I mean, that is not being talked about.
See, one thing is every investor, as I said, would have a different way of investing. I would say that the most overrated is, trying to figure out when to buy, when to sell on a daily basis. It just adds to the noise. It doesn't add to the returns. I think the most underrated is the compounding effect. In Reliance, when I was managing growth fund, we became 100x in 100 years, 21 years. But that was a CAGR of only 20 to 23%, which is great, but it doesn't look very big. But when you see, 100x in 21 years, that looks very, very big. I think investors, instead of looking at who did the best in the last 1 year and switching from one fund to the other fund, I think more than that, they should find someone who will be very consistent and who would keep on just adding to the returns.
Yeah, Sunil, that's a great point. To actually stick to a particular investment and stay with it. So that allowing it to compound assets. So before we wind up this discussion, our listeners would want to know some important advice on investing. What would you advise them?
See, investing, one has to be first positive on the underlying country and the asset class. So I think if you are positive that India is going to grow from 4 trillion to 8 trillion over the next 8 years, then you should definitely invest in equity. Second is, don't try to maximize return every day. I think equity is ultimately investing in companies, and your returns are going to be commensurate with the earnings growth of the company. I think the other thing is you have to give time to your investments. You can't invest for 1 month, 2 months, and 6 months and then get scared because of some event. Because then you will be entering at the wrong time and exiting at the wrong time. More important in this today's world where knowledge and information has become a commodity, I think don't microanalyze everything. Something or the other will be wrong in some part of the world. I think that doesn't mean that you get negative and disillusioned from investing. I think you have to just look at the broad perspective. And as I said, be confident on the country you're investing on, the asset class, you will make money.
Great. Thank you, Sunil, for joining in. It was great talking to you. I'm sure our listeners would have benefit.
No, thanks a lot. And thanks for having me. It was a pleasure sharing my experience with your viewers. I hope they find it useful. Thank you.
With this, we wrap up our episode. The key takeaway from both conversations is that money is not just about getting lucky. It's more about having proper systems in place that need to be followed with a lot of discipline and patience. Thank you once again, Kenneth and Sunil, for joining us in this conversation. And a big thank you to our listeners. This episode was produced by Vinay Joshi and the sound was designed by Amrit Reji. This is your host Nishant Vasudevan signing off. Thank you and stay tuned.